Okay, well, let's move on. We beat that. We sung that one
Yep.
to the fat lady sings. I don't
Yeah.
know. Opera. Get it? All right, move on. Now, Brett's going to look at a viewer question on D2L or DTOL on the TSX.
Yeah, this is a company we've had, I don't know how many questions on at this point. We keep getting recurring questions on it. It's an interesting company. But if you're unaware, D2L or the symbol DTOL on the TSX is a provider of online education through a simple cloud platform. The company serves over 18 million K-12 higher education and corporate education users across North America, Europe, and Australia. The stock is trading at $14.41 a share at a $793 million market cap. The stock had a strong end to 2024, rising really throughout all of 2024, but then it fell back, and it had a bit of recovery since then. We've done a couple segments on it. It's higher than the initial segment I did on it, and lower than the one Ryan did. So we're nice and in the middle right now. But if you go back to its 2021 IPO, it is still trading below that $17 initial offering price. But given that hot IPO market at the time, a lot of them are trading below because it was really just a great time to IPO. If you were going to IPO, great time because you got higher valuations than likely you should have at that time. So it's not actually surprising it came back down. It's done really better than a lot of IPOs that happened at that time. So even though it is down over that 5 years, you can see it went quite a bit lower not long after, like most companies that IPO during that time. But for the last quarter, we'll move to some of the financials. This is fiscal Q1 2026. They do have a different fiscal to calendar year, which this just reported last week. And as well, figures you should note are in US dollars, and they do have some foreign exchange effects due to that. Subscription revenue was up 11.1% to $47.7 million, while professional services fell 8% to $5.1 million, causing total revenue to grow by 8.9% to $52.8 million. The subscription revenue is recurring and generally contracted at and has terms between 3 to 5 years. So longer terms than many other SaaS models, which is great to see. A lot of SaaS models, it will be a year or less monthly rate. So that's good to see these long contracts because it really gives that foresight into what's going to happen. Revenue is not lumpy. As well, the company does benefit from low customer concentration with no customer representing more than 10% of revenue. That is a concern because occasionally you'll have some SaaS companies that'll be over dependent on one major, like a Microsoft, a hyperscaler, or something like that, where they're selling 30%, 40% of the revenue, and then they lose that contract, that falls out. So even though it was recurring, if you're overly concentrated, that can be a weakness for SaaS companies, but you don't see that in D2L, which is great. The company operates internationally, but primarily in the US and Canada, and it is impacted by those currency fluctuations, as I mentioned before. So on a constant currency basis, revenue actually grew at a bit of higher pace at 10.5%. Adjusted gross profit removes the impact of amortization and stock compensation, grew by 14.7% to 37.7% at a margin of 71.3%. That is an increase from 67.7%. That is a big increase for a margin year over year. The increase in margin was due to efficiency and optimization, as well as the scale. The management did note that Q1 margin was a bit higher by about 100 basis points than expected on a run rate. So going forward, and they expect something closer to 100 basis points lower. So 70% for the year. So don't be expecting that 71% to last throughout the year. Adjusted EBITDA grew to $9.3 million from $4 million. So massive over 100% growth there at a 17.6% margin. GAAP net income grew to $3.3 million from $572,000. Prior to this last year, they were really kind of teetering on that slight loss, slight profitability metric, and now they seem to be really trending into more consistently, at least, GAAP net income. Operating cash flows are negative. I will highlight this because they do receive normally upfront cash payments with their contracts, and there's a seasonal low in Q1 and a seasonal high in Q2. As long as the company does manage its working capital, this is an overall positive having the cash up front, but you will have these lumpy quarters. You do have cash flow decreases during a quarter, but on an annual basis, it is positive, but you do just need to be aware of that if you are looking at this company. So speaking of working capital, the company does have just really a great, strong net cash position. There we go. The company holds $92.5 million in cash and has leases of $11.9 million with no other actual debt, causing a net cash position of $80.6 million. But I will note as well the company does have $5 million of contingent consideration relating to their acquisition of H5P last year, which the payment will occur in fiscal Q3 of 2026. So you'll see a $5 million decrease whenever that payment comes due. But overall, great balance sheet. Shifting to the guidance for the fiscal year, the company maintained its initial guidance with the Q1 earnings. The company expects subscription revenue of 194 to 196 million. That's 7 to 9% growth. Total revenue of 219 to 221 million, implying a 7 to 8% growth. Adjusted EBITDA is expected to be between 32 and 34 million at a margin of 15%. This is a 17.5% implied growth from the midpoint of their guidance. Over the medium term, which is until 2028 for them, management expects 10 to 15% annual revenue growth and an adjusted EBITDA margin of 18 to 20%, which they do seem to be on track at this time, at least. The revenue growth is a bit lower, but if you get some acquisitions in there, it makes sense. The company is trading at a forward EV/EBITDA, this off of management's guidance, of 15.3 times and the EV to sales of 2.3 times, which is lower than what it was only really at the start of the year, but it's not overtly cheap either at this time, but it is relatively cheap compared to what it was at least. Overall, what I like is that recurring revenue model. That is really a true SaaS company. You see that consistent growth. The structure of the contracts is longer, which is great. It provides that reliability. It's with really public institutions or large private universities, which gives a bit more weight to the SaaS variance. You have that reliability is what we want to get at. The company has a strong balance sheet, which is always great to see. The company is now pushing further into GAAP profitability compared to last year. We just saw it edging on profitability. The company does actually benefit from AI with its Lumi offering, giving it an edge over legacy edtech offerings. You obviously have competition in that space, so the other bigger players in the space can obviously push into AI, and they are. But that's really something which they can replace with those legacy edtech offerings, which is what they are actively replacing in the US at this time. Lastly, the company has the balance sheet strength to acquire company, but the M&A market is really mixed right now. The company noted that they're really seeing two market types at this time. Either you have the poor performance just sitting on the market or going bankrupt, and then you have the great companies that you would want to acquire, but they're still at a higher valuation at this time. You really haven't seen those come down in price. They did mention that they are waiting for an acquisition that fits their strategy, and it has a building pipeline for this. But there's been no actual acquisitions announced as of since H5P. An acquisition would be really a great catalyst for the company, but of course it can be negative if you just rush into an acquisition, you overpay, or you get a really poor performing company or assets, and you just don't want that to happen. You want the acquisition to be right and fit the company and not be a forced acquisition just to acquire. You do see that from acquire to growth companies from time to time, where they just acquire everything under the sun at any price just to acquire to have that top line grow. You don't want to see that, and D2L seems to at least be doing it well. They're not rushing into things, but you do need to see an acquisition at some point. Otherwise, you're just sitting on cash at a point. A short-term risk for the company is that macroeconomic environment and policy risk in the US, which could cause both stock price swings as well as some fundamental volatility. Depending on where the policy lands, we'll really have to just wait and see for that. D2L really can't predict that or see how that's going to affect their pipeline. They did notice that they're not seeing things getting pushed out the year at this time. Things are maybe delayed a quarter or two. So if it was expected in Q1, it might be in Q2 or Q3 for any new contracts, but they're not seeing it being pushed out dramatically at this time, just maybe a quarter or two. Overall, the company is trading near fair value. You could definitely argue at a slight discount at this time, but I wouldn't call it an overly screaming or fire sale discount at this time either. The growth is looking good, but it's still not overtly cheap either. It's not one of those discounts which you need to go buy this today effectively, but it's a company we'll continue to watch going forward, really see how it develops, see if they can do any more acquisitions, see really how the macroeconomic and policy environment develops.
Yeah, it's a good summary. I think it's a company that will, because of that balance sheet, because of the relatively predictive over an annual basis revenue stream that it has, we monitor closely. And, if there was some uncertainty, a pullback in the markets and it, clipped off 25%, which, in a company like this, that can happen. Then, maybe it's a company we're looking at. If the underlying fundamentals continue to suggest growth and you can get it at more of a reasonable price, it would be a company we'd look at for sure. So it's one we monitor closely.
Yeah, it was one of those companies that really fell with the tariff war that Trump did.
Mhm.
It was just trading just under $17 or so at that time, just before his liberation day. Then it fell to about 12, and that's while it was only a short period, and that was happened to I don't know how many companies, effectively every company,
Yeah.
really. But you'd be looking for a pullback like that, even if it's not a broad market pullback, to really get into a company like this, or just wait until the price stays the same for the next year or two, and the fundamentals are overall improved, or the price stays the same.